This is the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. We interview industry experts to unlock key information that will help young professionals break into the multifamily world in order to create long-term and short-term wealth. If you enjoyed the show, please head over to iTunes and leave a rating and written review so we can reach more listeners.
Hello, and welcome to another episode of the Millennials in Multifamily podcast. I'm your host, John Stober, with my co-host, Fritz Ritter, and today our guest is Sam Bates of Trinity Capital Group in Dallas-Fort Worth. Before becoming an active investor, Sam invested as a limited partner in a deal that underperformed, and it was at that point he realized he needed to control his own destiny. That was in 2009. And since then, Sam has been directly involved in the acquisition, rehabilitation, disposition, and management of around $75 million worth of multifamily and single-family real estate.
Sam Bates, thank you so much for joining us on today's episode of the Millennials and Multifamily podcast. Before we get into today's episode, could you just give us and our listeners a bit more about your background and how you got into the real estate investing business?
Yes, John, thank you for having me on, and I hope to add value and be able to help your listeners either invest in real estate or even grow their portfolio. But I got started, my background's in finance, and I thought I was going to go get my master's in real estate immediately after. And then I worked at an investment private wealth company out in LA and decided to stay out there. So I was an investment analyst and put together portfolios for the high net worth individuals and wealthy people out in Beverly Hills. And then I decided to get my master's, and after working at UBS, I decided to go the stock route, and I got my master's in personal financial planning and an MBA. Then when the market crashed, I knew I couldn't really trust raising capital from people and putting them in something in a security that I had no control over. And I started working at a consulting firm, and it just wasn't my cup of tea, and I didn't want to do it for 40 years. So I thought there had to be a better way out. And I was drawn back to real estate. I wouldn't call it my first love or anything. I didn't know much about it. I lived in a house my entire life, but that was about it. So I started digging into books and reading a lot of books. And then I joined a investment club or mentorship club back in like 2009. And that was kind of the first step into becoming a real estate investor. I invested as a limited partner in a 208 unit deal in Dallas. And then I did roughly 20 single family deals from 2010 to 13 or 14. And then I started looking for multifamily deals, and I met a partner who I used to work with at one of the consulting firms, and we decided to partner up, and that's kind of where it went from there.
So what made you transition from the single family route and the limited partner route to saying, hey, I'm going to go do these big multifamily deals and developments that you're doing right now?
Yeah, I transitioned initially from the limited partner route because the partnership I invested in a one partnership. We went through DD. The general partner backed out of the deal, and he took like $13,000 of my initial investment and said that was part of the DD fees, which I would never do to a limited partner. If we go through the deal and it doesn't close, it's our responsibility. It's just what we would do to cover some of the costs. And that kind of rubbed me wrong. And then the next deal I invested in as a limited partner, it did well overall, but there was a lot of issues. The price we bought it for door was under $15,000 a unit. So we should have done significantly better than we did. We had to change property management companies essentially 3 times. We kicked the general partner out, and 2 limited partners came in. So there was just a lot of instability in both of those transactions. And at that time I was like, well, I don't have enough to buy an apartment complex. And I was working probably any given week, 50 to 70 hours in consulting. So I didn't have the time either to really focus on multifamily. So I was like, I can take down a lot of single family in a pretty short period of time. and I loved it, and the returns are good. Now it's probably a little bit harder because I was buying houses fully rehabbed for under $100,000 in Dallas, which now is unheard of. But it just wasn't scalable. Like, I was still working my job, and I'd have to hire GCs, or I'd have to spend all my time at night or on the weekends dealing with a single family. And with multifamily, it's scalable. It's a business that you can basically put a property management company in. It's accounted for on the P&L. Obviously, you have to oversee them and manage them. Depending on the management company, you have to manage them really well. But it's just a lot easier. I think it's a lot easier to raise funds for multifamily syndication than a single family fund or even just one-off fix and flip. So those were the main reasons I decided to move into multifamily.
Do you think being an LP first helped you understand a little bit more about the deals and how to maybe treat future LPs in your deals?
Yeah, it definitely did. I think it taught me what to do and what not to do in regards to a lot of communication, because when things were going well, the GPs seemed to communicate all the time. And then, and maybe honestly too much. I'm more of a details guy, so maybe some investors want a 3-4 page email, but I just kind of want bullet points. And when things were going bad, you couldn't even get a hold of them on the phone. And that taught me no matter what's good, bad, and if it's bad news, you should communicate it as soon as you find out about it. At least on a monthly basis through your investor communication. If it's really bad news, you should communicate it immediately. Like we had a shooting at one of the properties we own. Luckily, it wasn't we had a gun backfire. Nobody was killed. It accidentally went off, but it went through another residence unit, and they were petrified. So instead of waiting till the next month and telling them in the investor communication, I sent out an email as soon as I found out, basically explaining the situation, telling them nobody was shot, nobody was meaning to shoot the gun, it just happened. And now we're having to basically take care of the tenant that was a good tenant and trying to get her to stay because she had been there for 4 years, and then immediately removing the tenant who claims the gun went off accidentally. He was in the military. I feel like there's some other issues and that he just wasn't sharing with us. So if you're in the military, you know how to handle a gun. And I just think we didn't have the full picture of the story. But yeah, and to get back to your question, to go through the process, I was young. I was young to mid-20s when I first invested as an LP. So there was a lot of stuff didn't know I was green about, and I learned. And with my finance and accounting background, I understood what a P&L was. I understood a lot of different things from a financial standpoint. But I'd pick up different nuances with operations and even going through the P&L that I didn't know at that time that I thought was really beneficial to know as a general partner in the future.
So Sam, I have a similar background to you. You know, I'm good with numbers and spreadsheets and finance. I'm curious, how did you leverage that finance and accounting background and the experience at UBS to start taking an active role in your own multifamily and development deals?
I think the biggest way I leveraged that experience is we built out our own underwriting models. And I know there's a lot of underwriting models you can buy from people, and we just felt like it'd be important for us to know exactly how it flows. Mm-hmm. And one of my partners, he's also a CPA. So he has a very analytical mindset, and we just sat down and built it out, and we've tweaked it over the years, and we've tweaked it depending on the different deal and structures we've done, because we've done obviously apartment syndications, but we've done land developments, we've done RV parks, retail development. So there's different specifications of each deal that we need to tweak. But I think just having that base financial understanding was really, really helpful. And then working at UBS, I didn't work a lot in the debt market or with the bond market, but I understood and I could pick it up pretty quickly. And when I was talking to mortgage brokers, I understood exactly what they were talking about, where some people who doesn't have that financial backing might take a little while to understand the terminology or what they're referring to.
So with you looking at so many different types of deals, I mean, were you building out your own underwriting models for each type?
We built out for apartments, and we initially were looking just at apartments, and this was back in 2014. And for 2 years, we didn't get a deal. Partly it was our fault. I think we underwrote too conservatively. We're concerned about raising money from other people and then possibly losing it. And people were saying at that time the market's going to correct in 16 or maybe 17 would be the longest, which looking back, we could have thrown anything at the wall, closed our eyes, and probably 2 to 3x our money. But so we had that issue. And then since we were younger, we had 2 or 3 mortgage brokers in Dallas literally flat out tell us that they didn't believe we could raise capital. Because at that time, I had left that real estate investment group and we weren't a part of any type of group. And in Dallas, specifically Dallas and in Texas, some of the real estate groups are large and they have a big pool. So if you don't have experience, if you're in one of those groups, they know you can raise the money. But if you're off on your own, they question a little bit more. So after doing that for 2 years and getting nowhere, we brought in a third guy who had built mainly single family homes, but he'd built apartments and office buildings and retail strip centers before. So our first project was actually a mixed use development. And we built out since we had the apartment model built out, it was pretty easy to just plug and chug for the mixed use side, because we already had 2 triple net tenants, and it was pretty easy to figure out the returns that we're going to get from those investments.
So I wanted to ask you, what were some ways that you corrected your overly conservative underwriting to be more competitive? And what are some things you found that you think many other beginners probably are overly conservative on?
That's a really good question. And I feel like that's been maybe one of my problems throughout my real estate journey, because we've still yet to get a deal in Dallas. And these big markets, most of our product is in secondary and tertiary markets where there's less competition. But I was always projecting the exit cap to be usually 10 to 20 basis points per year higher than the entrance cap. And I think that hurt us a lot, and that's changed. And now I can justify it because, I mean, we're using the going in cap as the exit cap, or maybe a little bit higher, but definitely not 10 basis points a year. And as the Fed said that they're going to keep interest rates low, at least till 2023, it's easily justifiable. And I think the way the Fed's print off money, the way our economy is right now, interest rates are going to stay low for the foreseeable future. And then now I have relationships with a lot of property managers. So I'll underwrite it. And then there's one property management company that manages a few of our deals, and they'll look at it if they're going to get it. And I can kind of compare my projections to their projections. I've also got a little more aggressive in some ways to add income. I feel like, especially Texas, maybe not so much in Mississippi or Atlanta area where we have other properties, but Texas, I mean, they charge for everything. And people pay for it. And the operators, they see it done once, so it's rinse and repeat. So I've gotten more aggressive on what income we can add. Property taxes in Texas is really hard. It's by far one of our largest expenses. So I'm still conservative on that, but there's a few items on the expense side I've gotten a little more aggressive on. And the more we've operated deals and more I've known what we can operate exactly at, has helped me increase the accuracy in my underwriting, not just do rule of thumbs, which most people tell you to do.
As I'm going through, like the finance side of our first deal, I'm noticing the same thing. Just when you have experience and operational experience, you start to see like what actual expenses are. For someone who's still looking for their first deal, though, how can they figure out like which rules of thumbs are just way too conservative, or if their property management is like sandbagging the budget?
Yeah. Sometimes it's kind of hard to tell. And for instance, like it used to be a good rule of thumb was labor or payroll should be like 1,000, maybe 1,100 a door. Well, most payroll, depending on the size of the unit, like a lot of payroll now is at 13, 14, maybe even 1,600 a unit, depending on what property management company you use. Because we have now, I'll be working with 5 different property managers, and some can run it closer to that $1,000 a unit, but there's a few that they tend to, I think it's a good thing, but they tend to pay a little bit more to get a higher quality worker, and we're closer to 1,500 a unit. So, and it depends on the market. Like one market we're in it's a huge military town, which is great for a tenant base, but our workers, they're far and few between. And like when COVID first hit and the unemployment benefits rolled out, we couldn't hire a maintenance guy because they were making more money on unemployment than they were working 40 hours a week. So there are rules of thumb, but I don't like to use them because they're all different. And like when I was in consulting, we use acronym DOTS, depends on the state. And I feel like it applies to multifamily in a lot of ways because costs dramatically can be different. I mean, property taxes is dramatically higher in Texas than it might be in Mississippi, or insurance is a lot higher in Texas than it would be in another place. So it just kind of depends on your local market.
With property taxes, I know a lot of people well, maybe not a lot, but some people will get aggressive and do like entity purchases to try to get past like tax increases. Do you recommend doing that to get deals in this market?
I've never done an entity purchase. That's actually maybe a pretty smart idea. I think it would help. I think you can also strategically try to get around not get around property taxes, but strategically plan. Like for this Atlanta deal we're closing, we were supposed to close at the end of 2020. And with my background, I knew Georgia was an assessment state on 1/1. So we purposely are closing in January to have the assessment date pushed essentially another year. So for a year, we're getting the previous year's taxes. Maybe with an incremental increase, but not the entire increase in value that we're having to pay versus the assessed value that the county has.
Mm-hmm. And so I think you mentioned you invested in Mississippi, Texas, and now Atlanta. I mean, it takes time, at least in my experience, to learn a market. So how are you able to operate in so many markets and really like hone in on the numbers?
Well, with the Atlanta property, the partner I'm buying the deal with, he already has property in Atlanta. And he has an investment banking background and he's very big into data. So I rely on him heavily for that. And I've looked in Atlanta periodically over the last 3 or 4 years. So I have a decent idea of that market. With Mississippi, I was talking to several brokers in Memphis and I kept looking at deals in the market. And this one just kind of popped off the page. And honestly, we probably wouldn't have bought it if we didn't think it was going to be such a great home run. And like we bought it in March of 19 and we've raised rents almost $300 now on average. So,
nice.
And it was built in 2005, which is kind of unheard of, but the owner, they were just completely mismanaging it. And you could see that in the financials. And I don't know why more people didn't see it, but like we were actually the runner up to it, and another group couldn't come to terms on the PSA. So it fell out of contract and we came in and we were like, yes, we definitely want it. But I'll look at every market from a macro standpoint, and obviously I want population growth, employment growth, and then it depends on the vintage and the asset we're buying, but I'll never buy anything under like a 40,000 median income. And if it's a new build, we want closer to like 70 or 80,000, just because each tenant makes so much and you can only have the rent so much greater than what they make. So it's just kind of a numbers and equation calculation, but there's a few companies. I mean, one of my partners actually owns a Chick-fil-A, and Chick-fil-A, Orange Theory, Starbucks, they pump a lot of money into marketing. They pump millions if not billions of dollars into marketing. So we'll search and kind of follow them. And like with my partner that works at Chick-fil-A, I won't say we get inside information, but we can see how stores are doing. And if they're doing really well, we're a lot more enticed to invest in that market than if they aren't. And if it's close to Starbucks or Orange Theory or a few other retail places that we've realized they pump a lot of money into real estate, if they're investing there, we feel like we're going to do pretty well.
Are you struggling to understand how to underwrite multifamily properties? Hi, I'm John Stober, and I completely understand your problem. I thought underwriting would come naturally to me due to my background in finance and accounting, but I quickly found out that there aren't a lot of resources that cover this subject. I had no idea whether what I was doing was right, wrong, or just original. I don't want you to have to pick up little nuggets here and there like I did. So I wrote an ebook called How to Analyze Big Apartment Buildings and Make Them Feel Small that puts together all the pieces of the puzzle. We're also giving away a deal analyzer with the ebook, and they're both completely free. Don't wait as long as I did to start chasing financial freedom. Go to bit.ly/underwriting ebook and get your free copy today.
So what are some red flag data points that you see when you're looking at a market? Like you talked about population growth, Starbucks in these areas. What are some red flags that you see? Like, is it like a Walmart or something? You know, what's some bad areas?
No, I don't know if I have one specific like retail or employer, but there's been some areas I've driven to or flown to, and you get out and it just looks depressed. And it looks like there's not much economy or not enough things going on. I'll look at crime. Even in Dallas, like I know pretty much where I will and where I won't invest, but down in Houston, it's hit or miss. So you can do a lot of research on crime in Houston, but until you actually drive it, you might not really know. I have family, I have a lot of friends in Houston, and was no zoning. You can literally be in a really nice residential neighborhood and take a step across the street and you're in the ghetto. So it's I think just seeing it, the crime is a big part. The data, income data doesn't lie. Maybe if there's a new, like Amazon, if they come into a place or some other big retailer that's going to inject a lot of money or capital into the economy, it's helpful. But usually when somebody's making $30,000, an employer is not going to change their lives that much unless it is like Amazon and they'll pump them up to $15 an hour or something. So from an employment standpoint, we'll look at like all the companies from California that are moving to Texas that are in the tech, or some of the other companies like Toyota that came to Plano. That was huge for DFW. So I think it's more macro and just kind of seeing what's happening and not looking at specific data points of why to get out or not invest in an area.
Okay. I question on it. So let's say you do some research and you see that a new company is moving there within plans to build a new plant within 5 years. How early is too early to start investing, do you think?
I mean, it might depend on the plant and the company, and if it's manufacturing, is it mostly automated manufacturing, or are they bringing a lot of jobs, and just what the population of that local economy or that city is. We've never, well, I won't say never. We try not to build anything under with a population of 30,000 people, but we did do a small development in a town or city, whatever you want to call it, that had 5,000 people, and it's done really well. But the supply was there's a few rentals, but it was basically zero. So we put in a small 48 unit complex and we leased it up really quickly. So I know that's not the answer you want, but it kind of depends on various factors. But yeah, I mean, if a plant's coming in and they're bringing a lot of jobs, I would think you could probably start pretty soon after they announce it.
Yeah, I guess I was more like, what's too early to go into a growing region? Like, let's say the local government's like, we got a 5-year plan or a 10-year plan, and what happens if it never happens? Like, did you make a bad investment?
Yeah.
Is there ways to kind of counteract that risk?
We've never experienced that before, so
yeah, I know it's a random question.
yeah. I mean, yeah, doing development is risky because you just don't know. One of the ways we mitigate the risk is we always do third-party. We hire third-party consultants, and they'll perform reports to see if there's demand. There's actually some land about an hour north of Dallas that we looked at, and the city's 40,000 or so, and it was going to be right across from a brand new, $30 million high school. It looked phenomenal. And we got the third party report back, and they said the demand for multifamily in that area was 300 new units. Well, we were going to build 276. There was another parcel not too far down that was slotted to have 300 multifamily units built. So at that point, it's like there's already 600, and there was no moratorium by the city to stop from somebody else doing it. So we just backed out because we were like, we can't project or predict what anybody else is going to do, and that demand might not be there once we get the apartments built in 2 years or 3 years.
So do you do that type of due diligence for existing multifamily, or is that more so for development?
No, that's for development. With the existing, it already proves that the demand's there. Mm-hmm. So maybe if it's in a decline market, like in the Rust Belt or somewhere where people are leaving the city or state, that might be something that we would do, but we've never invested where people are fleeing. So I don't think it's necessary for an existing multifamily.
So let's say, you get one of these studies back and the area looks good. Because development is it's a little speculative. You don't know where the rents are going to be or necessarily what the expenses will be in 1 to 2 years. If that study comes back good, though, are you more prone to just kind of make the numbers work because deep down that it's a good deal?
Yeah. I don't know if I'd say we make the numbers work. We'll underwrite it to where we think the numbers should be at. Mm-hmm. And this latest development, the planning and zoning process took a very long time. So we actually underwrote the project in 2017, and we didn't account for rent increases, and we're going to start leasing it next month. So our first year rental rates were based on 2017 rental rates. And over the last 4 years, the market in that the rents in that market have skyrocketed. So we're going to do a lot better than pro forma, but our whole period has extended 2 years longer than what we expected. So the return's it's actually going to be better for the investors, but it's almost kind of been a wash. But to answer your question, I would just underwrite it how you think it's going to perform, because even if the numbers or if the growth and population is there, you don't want to force something to maybe you don't want to force something that isn't a deal, because there's more land, there's more deals you can buy. I was looking at some land a few weeks ago, and we initially thought it was going to be great, and then the more we looked at it, the more concern we had about it. So we decided not to offer on it. And since then, we found 2 better tracts that look a lot more promising. So at least in DFW, maybe not in every market. I know Colorado, some parts of Colorado, some parts of New Mexico, you can't really build. But at least where we're at, you can build really easily. So if a deal doesn't work, we're just apt to move on to the next one.
Well, so earlier, you said in Dallas, I think it was in Dallas, you're underwriting like your other income a little bit more aggressively. Mm-hmm. If you do find like a great location, do you tend to get a little more aggressive with some of your assumptions?
Yes and no. Like, I don't change the expenses from what I think it would be, but like if we're looking at a deal in Austin, I'm going to project their growth rate higher compared to the growth rate of Mississippi.
Rent growth.
Yeah. Sorry, rent growth. And in Dallas, I think in the large metros, you can project more additional income than you can in the smaller metros, because people are just used to it. And like one thing that's becoming very popular in Dallas is smart technology, and residents will pay like $35 to $50 for an app where they control their thermostat, their lights, their locks, which in smaller secondary markets, there's no way you're going to get that. So you can underwrite more aggressively depending on where you're buying.
Do you adjust economic occupancy rates depending on the market?
Yes. I look at obviously the property and how it's performed, but we'll look at historical occupancy rates kind of for that city or that region. And we'll talk to the property managers and see kind of where they think they can run it at. And then look at the comps and see where they're at. Usually, I mean, I don't want to be too aggressive. I think the most aggressive I've ever been on physical occupancy is like 94%, 94%. Then economic occupancy kind of depends on the deal. I'm usually more conservative on the first year, then get more aggressive the longer we hold it.
Mm-hmm. And then, so I also wanted to get into, I think it's interesting that, you and your team, you guys sound like you all have these finance backgrounds, and you're doing like these really big deals. You bought a lot of real estate, and you always hear, well, find partners who have like different skill sets. So for you guys, with all having a similar skill set, how did you like fill out your team so you have someone who can, manage the assets or had construction experience?
Well, you're right in some regards, but one of my partners, he has almost 30 years of construction experience. So he's kind of the outlier, but we do overlap in a lot of regards, but we also have complementary skill sets. I'm more of a numbers guy, and I always make the comment, I have to be the bad guy no matter what. They make me fire all the property managers. They make me give people the bad news. So I guess I'm the hard ass. But then there's another guy who he owns the Chick-fil-A, and he manages 120 people almost right now. And he's really good at relationships and interpersonal skills. And a lot of the investors we have come from him, and he has a network of very high net worth individuals where we can talk to, and we've not had any issues thus far raising capital for projects, and I hope that continues. But over the last year or two, now that we have a track record, I'm starting to talk to a lot of institutional partners, family offices, trying to build out that side. And I don't know if we'll do a deal with an institutional partner, but I'd love to have that ability to do it. And just, it's great to have one or two LPs versus 35 or 50 LPs on a deal. So.
Yeah, and I'm kind of wondering, if you had that option, why would you decide to not go the institutional route?
Institutional route can be great in terms of access to capital and ease of capital, but they're going to be a lot more strict than your average individual investor. They have carve-outs or hurdles that if you don't meet them, they can instantaneously take over a deal. I don't know. They made their money they made their money because they're good at what they do, and they expect a higher performance maybe than a limited partner. And when somebody else is bringing, or when one person is bringing 75% of the equity versus 2% of the equity, they have a lot more say.
Yeah.
So there's just trade-offs between those. And since we haven't had an institution invest with us, I can't speak completely all the pros and cons about it, but just from some of the people that I know who work for institutional partners or who have worked with institutional partners on deals that they GP'd, that's just some of the feedback that I've received. And we've gotten a couple of hedge funds and PE shops to look at deals that we've bought, but we just haven't connected with one of them yet.
Hey, Sam, can you explain to our listeners the difference between family office, institutional, and funds?
Yeah. Well, family office is usually just one family, and they made their money in some type of industry, whether it be telecom, oil and gas, real estate, or whatever. And then they've built out an accounting investment department, and they'll look at deals and invest in deals. Private equity funds, some are geared towards real estate, some aren't. They just have capital to invest in deals. And then institutional capital. Private equity can fall in institutional capital, but that could also be, insurance companies, just corporations, corporate companies. Like BlackRock, I would say is an institutional fund, even though they're classified as private equity. So some of it's kind of synonymous with each other, but all of them are just usually very well. They have a lot of dry powder to invest in a deal.
And do they tend to invest in different types of deals? Like, if I go to some hot primary market and there's like a huge skyscraper development, is that more likely some institutional investor, or is that a syndicator like funding $100 million deal with LPs?
That would be institutional. Institutional asset or investors or private equity funds or family offices, a lot of them tend to invest in the core markets, the urban downtown, where you get a very safe investment, but historically the returns aren't as high as what they've been in your BC class assets. But every fund is different. So some might be more opportunistic. Some might want to invest in Dallas, but some don't. It kind of just depends on their risk profile and their tolerance and their objectives that they have for their investors or their family.
Well, Sam, so we are running up on time, and I wanted to make sure we got to our last section of the show called the Fast Five. And those are just the same 5 questions we ask every guest that comes on the show.
Awesome.
All right. So question number 1 is, if you were still in your early 20s and you had to start over, how would you do that?
I think there's two things I've learned throughout my life that are great for real estate investing. And you need to learn and you need to grow your network. So try to network as much as possible. And over the last like 5 years, I've read probably 200 books. And I don't know how many podcasts I've listened to, and just I'm constantly learning. So those are the two answers I'd give.
Mm-hmm.
How do you see young professionals adding the most value to experienced operators?
I think everybody has a skill set from either their knowledge base or from experience. And if they can come and just add value and not just necessarily ask, how can I help you? Because for us, it takes a little while to even kind of come up to think about how somebody could help us. So if they're good at, if they're good at analyzing markets, or if they're great with customers or something, just come and say, hey, I can do this. And if I need it, I'll be like, sure, let's see what you can do. And I've worked before for people for free. It's not fun, but I've gotten jobs from it and I've gained a lot of experience. And I think if somebody's really willing and hungry to get into industry, that's what they can do to show that they're hungry and wanting to learn.
I think that's like such a great tip too. Don't just go ask people like, hey, I'll work for free. How can I help? Like, there's a huge difference between saying, how can I help? And hey, like, I can analyze all your markets for you. Yeah.
And this might be taken away from like the rapid fire, but also because this has happened multiple times, and I'm a millennial, so I'm probably at fault with this too, but I've had multiple friends connect me with different people that reach out and want to learn, and we'll have a meeting or two, and then they never follow up, or they never do anything after what we talked about. So if you set a meeting with somebody, or if you want to learn from somebody, follow through with actions. And I think that'll get you really far in life, is just to follow through.
Mm-hmm. That's A1 advice. So question number 3 is, what's the biggest mistake you've made in your career, and how have you since adjusted your business?
The biggest mistake I made in real estate was probably on one of my single family flips. I was outsourcing it to a GC. I had never worked with him before. I met him once for coffee, seemed like a great guy. I gave him probably 30 or 40% of the renovation funds. He started working 2 weeks later. He's like, I need more money. So I came and gave him more money. Then I never heard from him again. Mm-hmm. And that mistake was probably all in all because the work he did was shoddy. So having to hire another contractor to come back in is probably a $40,000 or $50,000 mistake. So just learn to have better systems and processes in place, learn to screen your hires better, and just hold yourself and everybody else more accountable, because at that time I was working a significant amount. So I was just kind of like trusting him to do the job.
Mm-hmm.
I think everybody has a contractor story.
Yeah. Unfortunately, there's a lot of unreliable and untrustworthy contractors.
I feel like us spreadsheet guys and girls, we kind of have to get our teeth kicked in with the contractors. Unless you have a lot of construction renovation experience, you just don't know what you're getting in for.
Yeah, that's definitely true.
It's tough. Anyway, question number 4. What's been your favorite way to incorporate technology and social media into your business?
That's one thing I'm actually wanting to get better at. Even though I am a millennial, I don't use social media that often. And we have a business page on Facebook, but that's about all. And we've had our property managers start using social media, and even some are now getting into using TikTok and Instagram, which a lot of management companies won't use. So I think from a marketing standpoint of our properties, we're doing a really great job. But personally branding myself or the company, I could use all the advice anybody wants to give me.
Hey, everyone needs help with something.
Yeah.
Yeah. So the last question is, what book, it could be a documentary or something like that. What book has been most influential to you along your journey?
I think there's been a lot of books that have been influential. I mean, probably the number one, I'll give two, and everybody says Rich Dad, Poor Dad, but I read that in grad school and it kind of changed my paradigm and how I thought. And that's why when I was struggling and didn't like my consulting job, I was like, well, I should look at real estate. But the other one, I think that had a larger impact just on my entire life in general was Miracle Morning. And I highly recommend everybody read it. It's basically gives you 6 steps to do each morning. And if you aren't a morning person, you could do it at night or just sometime throughout the day. And it's the acronym SAVERS, and it's silence, affirmations, visualization, exercise, reading, and scribing. And before I read that book, I did none of them except exercise. So pulling all 6 of them together, I think has been life-changing in so many ways. So highly recommend it.
Love the Miracle Morning. They actually have a documentary now on Amazon about it. And I love it.
I don't have to read the book.
That's awesome.
No, you don't have to read, John.
All right. Well, Sam, thank you so much for being guest on the Millennials and Multifamily podcast. This has been awesome. If anyone wanted to reach out to connect or learn more about you and your company, what would be the best way for them to do that?
Yeah, you can call me at 972-855-7654, or you can email me at sam@trinitycapitaltexas.com. I'm also on social media, but if I don't answer immediately, don't get offended. I'll get to it at some point.
All right. Well, Sam, thank you so much.
All right. Thank you. It was a blast.
Thank you for listening to the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. If you enjoyed the show, please leave us a rating and a written review at iTunes so that we can connect with more people. Finally, head on over to kronosinvestmentpartners.com and sign up for our newsletter so you can stay updated on everything we're doing. If you're interested in partnering with us as we find new opportunities, you can also schedule a phone call with us under the Contact Us tab at kronosinvestmentpartners.com.